And welcome, Ari Rosenbaum here, that 401k Virtual Bunch, episode number 3. Um,
Hello.
Good, how are you? Mets are up 7-2, Greg, so last time I checked.
Thomas Nito.
Yeah, six RBIs. So before I get to it, I got a show for the other events. We got a virtual conference tomorrow. We went from 30 people signed up to 60 in a day. So plenty of time to sign up tomorrow. It starts at noon Eastern. Then we're going to do another one on September 25th. And then after that, who knows? We got a national virtual conference in January 21st to the 22nd. People have been signing up, which is great. And you'll get an email tomorrow reminding you about all these events because that's what I do. Of course, if you can't stand the countless emails, kindly unsubscribe. Don't send back to me and say remove. You could just click on that on your email. But anyway, that national event is going to be in January. Like I said, people are signing up, and you'll see all the information, where to sign up and all that stuff. Guest today is a good friend of mine, Lyle Himebaugh from Granite Group. I know Lyle a long time. Back when I was a lowly associate at that firm that I occasionally mention. It's funny. It's funny that what?
Not occasionally.
Yeah, too much. But I always kind of love those stories because there's a lesson to be learned by it. But what's funny is I was introduced to you and Richard, your partner, by Cherie Tallerman, and I mention that because there are certain times where I will develop a relationship with an advisor that I was introduced by somebody else, and then I will completely forget that person introduced me. So there's an advisor that I work with a lot in Florida, and we were at a dinner at the nearby golf club, very nice dinner, and sitting next to a fiduciary, a guy working for a TPA firm, and he says, I introduced you to this advisor, and I'm like, you know what? You're right. I completely forgot, how I got introduced. But that's the funny thing about networking and relationships and all that stuff. But, Lyle can attest how, as an associate, I tried very, very hard to get business. And Lyle and Richard took me out with one of our partners of the firm out to lunch. They never had business for me, those attorneys. But when it came to free lunch or free U.S. Open tickets, they were always kind enough to accept. So, but anyway, you've been a big supporter of that 401k conference, the live events that we had up until we closed down Disney World in March. For those who don't know, we had I think one of the last national events before the world caved in. Literally, the world caved in on the airplane ride back. The NBA suspended their season and whatnot. But you were a great supporter of the live events, and hopefully we will have them again. I talked to a good friend of ours who works for one of the large providers, and she tells me that she can't travel outside until April. So that means I'm probably not running events until April. I was planning on doing an event in Vegas in December. I did everything but sign the contract for the event. Not going to happen. I mean, you got to be a realist with these things. I just got word that the National Sports Collectors Convention that I was trying to go to in August in Atlantic City, and now it was going to be December. That's been canceled. So eventually we'll get back to the live events. Eventually. So we have to deal. Yeah. What?
Next year.
Hopefully.
Napa, Plant Sponsor, they're all going virtual this year.
Yeah, I got Napa. I think the email, always kind enough to send me the emails where they want sponsorships, kind of like what I do, but a lot less. But I see that they're doing a lot of virtual events, and not, you got to plan accordingly. I mean, there's nothing worse than going through the trouble of doing a live event and scheduling it, and then just having to cancel.
Yeah.
So So what was your favorite event that you've been to that we did?
I think there was a couple good ones in there. I like Disney World because I think at Disney, wasn't that Goose was there?
Goose Gossage was there.
Yeah, what a great guy. And I think when we went to LA, there's a what I really liked about the events is actually meeting some of these baseball players that have really high value systems. I was really impressed with who they were as a person, and because you always think about these sports stars today, these guys were just true blue, no smoke and mirrors. Really, really enjoyed meeting every single one of them. Really great guys, especially Dallas, the guy that
Everson Walls.
Yeah,
who took the tour with us in the stadium. He took the stadium tour with us, which was actually hilarious because there was at one point in the Dallas Cowboys locker room. There's actually above the lockers, there are pictures of all these all-stars. Anybody made the Pro Bowl, multiple Pro Bowls.
Yeah, 3 times.
Yeah. So in one of the corners is Everson Walls. He's up on there, and there are people who are not part of our tour that were part of another tour coming in and not recognizing that one of the guys in the locker room at that time is up on the wall. So it's kind of fun.
The commonality among all those fellows was they're just a high value system. It's amazing how each one of them in their own sport were spectacular athletes within their sport. And they all had the same type of high value. It's very interesting.
Yeah, and we're gonna do the virtual event, and with the virtual event, we are gonna bring in an athlete. My buddy and our buddy Larry Davis always provides the athlete appearances, and we've been talking, and we got somebody planned. Who, if I accomplish that one, will probably be the biggest guest I ever got, in my opinion. But that's.
All right, can we get a hint to who it is?
No, I can't give you a hint because.
Can you at least give us a sport?
No, if I give you the sport, then you'll probably know who it is.
No.
Yeah.
Then it's got to be a random sport. It can't be a big time sport. So you
you may not see it as a big sport, and when I say that, it's not NASCAR.
Tony Hawk?
No, that's not a sport. Skateboarding's not a sport. Now I'm going to go into a whole George Carlin routine, about what's a sport and what's not a sport.
Hey, Ari, quick segue. You mentioned George Carlin. I don't know if you heard, but Judd Apatow is doing a documentary series on HBO. So sorry for the sidebar. But
everybody knows George Carlin is one of my favorite comedians, top 3 or 4. And I did see him live at Stony Brook when I was a freshman at Stony Brook. I was in the front row. And he really just did a regurgitation of his latest HBO show. So it was great, but I kind of heard most of the jokes. So anyway, Lyle, getting back to you. You're based out of Connecticut. Tell how the history of how you formed Granite Group is. You and Richard go way, way back.
We go way back. Good story. Ari would not tell me any questions, so this is going to be totally spontaneous. Richard was head of quantitative analytics at Bernstein. Went over to Credit Suisse to head up the money management program there. Took it from $1 to $5 billion, and I was managing money at a firm called Donaldson Lufkin Jenrette (DLJ), and which was purchased by Credit Suisse. And I was managing money for First Citizens Bank in Trinidad. They had a large account with me, and I took Richard down. Didn't know Richard from Adam. And he was telling me how he was forced to do things that he didn't really want to do because he had to play for the team. And I was being told the same thing on the other side. And that was really the genesis of Granite Group, was to not have anything to sell and just have a process and just really at the end of the day, really just do the right thing for the client. So we can go out and get any investment, public or private, in the world. And then about 10 years ago, one of our private clients came to us and said, hey, I want you to do for my employees what you do for me inside the 401k. And I said, absolutely not, because I thought, and he said, why? Because you hired me because I don't get paid by anyone but you. And I negotiate, at the time you had to really negotiate fees down, not like today. And when I figured out a way how to do all that stuff, we got into the 401k business.
It's more than 10 years ago because I've already been out of that law firm for 10 years. No, it's about 12 years because I saw you. I think you might have come to my office. I don't know, in Broadway. I don't know what it was, but it's more than 10 years.
Okay, so I stand corrected. 12 years.
Listen, because I always remember after I left that firm and started my own, I went to your office in Wilton, and then I went to meet these advisors, these brokers came in Stanford.
Yeah.
And I, told you I was leaving to start my own firm, whatnot. And I remember telling these brokers who really wanted to work with me, and they only really wanted to work with me because they thought that my firm was bigger than they were or whatever. And I kind of told them, I'm leaving. Oh, but you're not a name, your firm is a name. I said, nobody outside of Long Island knows that firm. It's a Long Island firm. If you're outside of Long Island, you kind of don't know about it. And, they didn't want to do work with, they didn't want to refer me work because of my name. And then years later, because I'm such a pain in the rear end and I kind of like to, screw, with screwdriver. So I emailed them back once and I said, am I a name now? So anyway, 338. When 338 came about, when I first heard of 338, and that's going back around that time, 12, 13 years ago, the joke that I had was, what was the big deal about being a 338 in the sense that almost everybody was using passive funds, and anybody could pick, I'm not trying to put down 338s, but I always thought the 338s, they mitigated their risk by picking index funds for the fund lineup, which minimized their risk, but didn't differentiate themselves among every other 338. And you're different because you have an active approach, and that's part of your shtick when you do the 330, when you do that 401k conference events. That's what you talk about. So can you tell me a little bit about how your approach is just different than, other, which again, whether you're active or passive, it's, it's like arguing a religion. You believe what you want to believe, and they're both, pluses to both sides.
Yeah, I mean, I think we do have passive investments, but I want to correct you on one thing you said. It's not like you're mitigating risk with index funds. When you have an index fund, you're taking on market risk and getting market returns, less whatever the fee is. So, or the mutual fund fee. So, the idea is when you're a 338, regardless of what investments you use, you really need to have a process, and you have to have that process written down inside the investment policy statement. And in the investment policy statement, then you have to have analytics to prove out what you say in the IPS. So, it's not necessarily true that everyone should have a whole passive fund lineup. There's lots of lawsuits on that. There are certain sectors where you absolutely do never want to do any type of indexing, like emerging markets, fixed income, small cap. It's really to the disadvantage. In fact, I just spoke with an ERISA litigator where one particular very famous index fund family that starts with a V, their index funds actually underperformed the market by 20%. They index by 20%. So there's a case there that it might be causing harm to the employee by choosing the index. So you got to be very careful on how you go about it and make sure you document everything. So we have a process that we want to mitigate risk, but we do it with active managers because you can't mitigate risk with index funds. So we want what we do, and we apply this for private clients or whomever else, that we actually, to sum up a 5-hour dissertation, we find funds that have less risk, less volatility than the benchmark without giving up the return. So that means if the fund performs in line with the index but takes 30% less volatility, meaning a lot less of this, that's interesting. If they take more risk, then they have to have a much, much higher return. So I can tell you that our large cap value managers No one likes value this year. So if you're in the value index, large cap value index thing, you're down 9 or 10% or whatever it was. At one point, we were down 9 or 10% about a month ago. And our manager was down 5. So if you constantly do, and then on the upside, if the manager performs in line on the upside, you will eventually over time outperform the index. It's very important to just give it time. It's not how much you make on the upside, it's how much less you lose on the downside that will dictate the long-term performance. So it's very important to understand that concept. And if you're doing that on a consistent basis, the employees will retire. They will have a shot at retiring. So, and that's what this is really all about. I'm a big believer in the best interest clause before there was a best interest clause. So I think that's what we're all here for, is trying to, not only to really help people, but, really build a business. And you can't build a business unless you have process.
So how are you dealing with clients now with this crazy market, in the sense that, March looked like the market was going to go down 20, 30, 40%, and then it rallied. How do you deal with clients, plan participants, and your practice? Because it's maddening. I mean, I've done very, very well in the market by pouring money in, but
because you were reading my book.
Obviously the concern. we talk every now and then. Cause we have a favorite stock, but how are you dealing with the practice, clients, plan sponsors calling? Were they panicking? Were they on the roof come end of March? Or
there's two ways what we did. There's two things that we do that are very different, and this is good for the advisors on the line because we partner with advisors. Is that we must have done at least 40, 45 webinars to the employees on the markets. What to do. We put stuff on an investment education site that we developed for employees and for clients only. So it's really about communication. We were constantly in there. We were giving people, because we're money managers, right? So when the market was down on March 23rd, we were at 12 times forward numbers with stimulus and the interest rates going down. There was only one way for the market to go, regardless of what perceptions were. So we were telling things like, this is the time to either, if you can't afford to increase your contributions, at least keep the contributions, because we had slides in there that we, when you make a smiley face, you're just buying more shares at a cheaper price, and that will end up as a 42% increase in your wealth if you consistently do that. But we were giving out advice like, if you can afford it, increase your contributions now and not make contributions later, right? We were doing things like that. So we did all these webinars, and then we have a device, and this is for employees and for advisors, where we white label it for the advisor, and it gives out, the record keepers do a pretty good job at retirement planning, but they don't do any investment education. So I need to put away $1,000 a month. They don't know where to put it. So we created a whole system that is almost like an engagement tool for the advisor. It's about the markets, about how to make an allocation for themselves. And we just include it, but it really helped. We went from maybe a few hundred people a month going on this site to several thousand a month. I mean, it really became the tool of choice because people really needed some color on what to do. We were telling people to buy in March and April pretty aggressively. So, and it's all about having that one little, just having the tool and the communication device out there. You have to be very proactive with clients. That's what we did.
You see a lot of volatility between now and the election?
That's a great call. Listen, we've been out in public. We said this in our blog over the years. When Trump got elected, I didn't care if it was Bugs Bunny getting elected. When you're trading at 15 times earnings and you're going to cut the corporate tax rate, the markets are going to go up, right? It doesn't matter who the person is. Politics are not involved. And I'll say the same thing again. If Biden and Camilla get elected, they're running on the platform of increasing the corporate tax rate from 2028, with the market trading at a 30-40% premium to its historical average. That's not going to bode well for stocks. And it's not a statement on Biden or the party. Politics has nothing to do with this. It could be Bugs Bunny or Elmer Fudd in there saying that we're going to raise corporate taxes. That will not be a good move for the markets.
Do you think that's why the market went down yesterday at the same time as they announced her?
I think so.
Well, because, I think, so that's a great point. It's a great question. I think what happened was, listen, there's all these rumors and I can't substantiate anything. So I'm not making a judgment call, but the perception out there among the media is that Biden is like he's a little older and he's not, and so it might be a little slight dementia starting to happen or something. So people are probably looking at her as the next president. So so that was certainly a part of it. I would think it probably added to the anxiety. Plus, I think investors are just worried about the valuations in the market to start with, and I think so it probably added to it.
It should be an interesting next couple of months. Anybody who predicts anything is usually wrong about these things. And I always point out that it was my American elections campaign professor, Helmut Norpoth at Stony Brook, who 4 years ago said Trump was going to win, and everybody thought he was absolutely crazy. Mm-hmm. And he was my professor in the spring of '92 when Clinton was running. And up until 1992, nobody who lost the New Hampshire primary was ever elected president. And Clinton finished second to Paul Tsongas. Nobody remembers Paul Tsongas. May rest in peace. And, Clinton was a comeback kid. And my professor at the time said, Clinton's going to win. Clinton's going to beat Bush. And he came out and said that Bush was going to win 4 years ago. Trump in 2016. He said, according to his models, 91% chance that Trump is going to win this year. So we'll see. This year is different than all other years. It's kind of like Passover. You sing the song about the 4 questions. It's this year may be different from all other years. We'll see what happens. It should be really interesting, and we'll see. Your take on the fiduciary rule? Not that you've read it since you're an RIA, but what are your 2 cents on this proposal?
On the new fiduciary rule?
Yeah, the new fiduciary rules, I call it.
The new version. Listen, I just think in general, I think it's sad that we have to put in rules that that should be just common sense and for people that have high moral character. So,
but listen, you have a whole industry that want to work in that area, and they say, advice was never part of our business. I understand. I always try to look at other people's views, and I get what they're trying to do. But as an advisor, as an RIA, wouldn't you be against the rule that is watered down to bring them in?
I just don't think it's going to accomplish anything. I think I think all of us are just going to give out advice regardless. I think we're giving it out whether you're a 338 or a 321, or even if you're neither. I think people are just going to go out and I think most people, maybe I'm just too naive, I think people were going to just try to do the right thing to start with to help out people. So. But
anyway, somebody said that there's I heard somebody, I won't say who, it's a 95% chance this rule is going to be implemented. And I said, I don't see how that's a 95% chance, because it's all dependent on the election. The Democrats are against this rule. If they win, which there is a very good chance they will, it's more than 50% right now. I wouldn't say there's a 95% chance this rule gets into place. I say it's 50-50. I think it's less than 50-50. It's just interesting that, I always say I'm not going to be the ERISA attorney who's going to write 78 articles about all these, implications of this rule, because I don't have time to do that. And I also don't think that this rule is going to be implemented in the sense that it's going to go to next year. And like I said, there's a better than 50% chance right now that
it's already changed already. The industry's already changed, right? They've already, I think the industry's already progressed to a higher standard anyways. And I think the best interest rule and everything else is here to stay regardless of whatever new fiduciary rule that comes up.
What about the ESG thing with the Department of Labor? You're not a big fan of ESG funds.
Well, the problem with ESG funds, because I've done a lot of research on it, because we've had clients that wanted to put an ESG fund, and when you really look at it, they basically own Microsoft and Google. So if you want that, just buy a large cap growth fund. It is. I would think from a behavioral standpoint, applied behavioral mathematics that we use, I would think it's pretty similar. And the problem is with ESG funds, there's no standardization, right? There's no ESG benchmark. There's none of that stuff out there. So that becomes even more important. So the 338 who comes up with the ESG fund, he has to have it very well documented why he chose that one over another one. Because you can find ESG funds that were like a true environmental fund that are, they invest in companies that clean up oil spills and do stuff like that. Or there's ESG funds, and this is the majority of them out there right now, have huge positions in mid and large cap growth stocks. They're basically tech stocks. So think about that from a diversification standpoint. You're not really getting too much diversification between a large cap growth and mid cap growth and an ESG fund. So they behave the same. They're all the same. So you really have to do some due diligence. I think we've got a couple of finalists that we're going to use, but it's going to be more of an uncorrelated asset to the large and mid cap growth. And it's going to be our definition, right?
You see the use of ESG funds as kind of, I wouldn't say irresponsible, but you don't see a lot of plans out there with sector funds.
With what kind of
sector funds? You don't see, maybe you get a real estate, real estate fund, but you don't see anybody having a technology fund or a communications fund or an energy fund in a plan anymore.
I think that's a good idea because the market determines how well the manager does, not the manager. So right now, large cap growth is in favor. Yeah, if you don't own any of the FANG stocks, you probably haven't done that well in the last 2 or 3 years. Well, you still did okay, just not as well as the other funds. Especially if you have value down and growth up. The bifurcation between the two returns this year has never been this great in my history since I think last time I saw this was 1999, when large cap growth was up I think 28.6 and value was down 4.5%. So I think it's tough. I think sector funds are really tough because if you were in technology, you did great. But if you were in healthcare or commodities, you did very poorly. So I think it's good because people put in an investment and think it's going to be good forever, and they forget it, and then they wake up. Listen, if you put money into commodities 7 years ago, you're still down. Right, the market's up 100% since then, 100, whatever it is. I mean, it's not a good idea to do sector funds. Look at real estate funds.
Is ESG really? I mean, to me, it always sounded to me like better marketing than anything else. Like it sounds like, okay, I'm going to do good, and here's a fund, and we all think we're going to do great because we're not going to invest in Exxon Mobil and Philip Morris and
But oddly enough, Exxon is probably one of the biggest buyers of trying to make the environment better. It's crazy, right? So why wouldn't they qualify? But then it goes back to the definition of what do you recognize as a true ESG fund, or ESG, that type of governance. There's no answer on this right now. Like, I don't really understand. I wouldn't definitely not make them. There was some stuff about making them QDIAs, but it would be virtually impossible to make an ESG a QDIA at the moment because of the lack of standardization.
Do you think that would open up because there's so much it's so up in the air, especially as it relates to performance with ESGs? Do you think that could open up some litigation? Like, Ari, what do you see from an ERISA standpoint?
I absolutely listen. I've been talking to ERISA attorneys like crazy. Like Ari, and I think there's going to be all kinds of new litigation for the Jerry Schlichters of the world, right? I think there's going to be, you have to have a process. You don't have to have the biggest or the best process. You could have a horrible process, but in the eyes of the law, as long as you maintain whatever you say your process is going to be, you're fine. You can have the worst process. You can say this or that, and as long as you do it, they can't really come after you that badly. So on the ESG side, I think because there's such a lack of direction and standardization, if you don't have it defined, well, it's like having a target date fund family too, same premise. If you have a target date fund, there's 50 target date funds. There's 50 different ways to manage a 2045 target date fund. How did you get to choose that particular target date fund? How did you get to choose that particular ESG fund? You really need to have it documented and how you.
Best recommendation is for anybody who has a ESG fund to look to the investment policy statement and see what can be fixed or what needs to be fixed to get that into line and avoid some of the headaches later on. Because, you know, even to me, for most medium small plans, you're not worried about Jerry Schlichter. You're worried about the DOL auditor who's reviewing your plan and asking you for your process in place. And we're asking questions that 10 years ago they never bothered to ask. In terms of litigation, listen, you can only...
Yeah, they're not going after $100 million plans anymore. They're going after $10 million plans.
Yeah, I mean, they'll go after 50, 25, whatever they can get at. But they're always coming out with new legal theories to make money. I always joke some of the ERISA attorneys, not Jerry Schlichter, but some of the people that follow him, it kind of reminds me of the scene in Donnie Brasco when they're trying to make money for the take for the week. And I think it was Bruno Kirby's character. They had like a parking meter, and they're hitting the parking meter to get the quarters out because they got to steal the quarters in order to make money for the take. And I think that you know is why you have you had some ERISA attorney who sat down. You know, Shell cross-selling. You know, they're using Shell 401ks participant data to cross-sell investment products. That's a great lawsuit. We're going to make the theory that plan data about participants is a plan asset.
Yeah.
And you sit there and you say, you know what? Because I'm not a litigator. I don't think like that. And I'm like, you know what? I don't necessarily buy it, but it's not for me to buy. It's for a judge to buy in an argument when there's a motion to dismiss by defendant's counsel. And what the judge will decide whether there's a case to go forward will be everything. But, you know, in terms of ESG, you know, if there's a large plan that's got ESG and we have this guidance by the Department of Labor and they've done nothing to review this investment, you know, that could be a huge problem.
Just document everything, logic behind how you got there.
Right.
That's and you'll be okay. So.
Exactly.
Can I ask you a question?
Yes, sir.
You were talking about tax rates earlier, and you know, if tax rates have increased in the effect you would expect on the market, what about the budget deficit?
The budget deficit is always, you know, we've had a budget deficit since time began. I think the last time we had a surplus was with Clinton for about a year, and I think the time before that was Nixon.
So LBJ, I think, had it.
You know, that's what I know. So the budget deficit is very concerning because what you have to understand about that just takes away more disposable income. So when we all pay taxes, right, our taxes are going to go to pay and service the debt, right? So that means there's money getting reinvested in infrastructure and all these other things, and it's just going to cut into GDP. That's why rates are going to stay low, because if rates go up, the cost of servicing that debt will go even higher. And that's going to be a real big problem. I think we're, you know, after this, listen, I'm not blaming the current administration for, you know, all the COVID monies coming out. They had to do that and people would have been wiped out. But at the same time, you know, we've created a multi-generational debt burden on, I don't have any, on my children's unborn children, right? So it's going to take decades and decades. What we need is a bunch of politicians to get together and have a surplus budget. Forget about balanced budget. We need a surplus budget and have it dedicated to paying off some debt. And that's going to be virtually impossible right now with the way things are with going with small business, you know, hurting as bad as it is. So, you know, but that's going to be a big problem. We're going to be, when we're done with all this, we're probably going to be around 26, 27 trillion in debt. That's going to cut into our GDP. So that's why I think the economy is going to slow down. And I also think that's why, you know, when you look at the current market valuations and you look at what's out there, you know, you just got to be somewhat cautious in how you invest today, as opposed to March 23rd.
Okay. Last but not least, pooled employer plans. Are they going to be the greatest thing since sliced bread? Not that sliced bread was the biggest thing ever, but I just love that expression.
Depends if it was multi-grain or not, you know. So yeah, I would think. Listen, they're here to stay. We've been pretty vocal. We set up a GGA map just for advisors. My concern is they are going to be here to stay. It depends on what form. I know that like places like Vanguard, and they said this on the Wall Street Journal, I believe it was June 16th of this year, they're creating a pooled employer plan that has robo-advising. They basically said, advisors not need apply. All right, this is not for the advisors, which means they're going after the advisors' book of business. And they're just going to start marketing this stuff. And they're not going to be the only ones. Or they'll have a pooled employer plan that they'll dictate what the advisor will receive. And
we had a very large provider bought by an RIA firm, which I won't name who was, but they just bought like $1 billion RIA firm. I mean, that's to me that looks odd if I'm an RIA.
Yep. So it's just selling product, right? So I think, and this goes back to the communication, being proactive with your clients and always being out there, and you'll never lose them. But if you slip up, there's all these open maps. I think open maps are great and PEPs are great. And I think that's going to be a real, I think advisors are going to have to align themselves, especially, on smaller plans with a provider that can give them all the bells and whistles without losing the client. So I think that's where they're going to go.
Yeah, I think my concern is, again, having experienced the open MEP, I would call them the open MEP wars, but 90 to 95% of these PEPs are going to fail.
I agree.
Because everybody wants one of their own. And I think,
there's only so much to go around. Like, listen, we have an open map. I invited all the advisors to put in. I put in 316, 338, education website, logins for employees and everything else out there. And there's, and it's tough, and we're supporting it, right? But I think people that want to set up their own maps, they better have a large client base to do it with. And you have to remember that MEPs and PEPs are not right for everybody. You just can't force it into all. Some plans should just never be in a MEP or a PEP or any type of pooled investment, right? Wouldn't you agree?
Yeah, I mean, I've seen so many of them fail. They don't realize that if you don't pull enough assets, that audit is going to be is a killer. When you have 100 heads on a plan and you have a $10,000 audit, that drives up the costs. And I've seen too many MEPs fail. I think too many advisors, if they don't think carefully, they're going to cannibalize their business by trying to push all their current clients into a PEP that doesn't necessarily be a good fit. I think they're better off joining a larger PEP that gives them an opportunity to, partner up with somebody whose fund money they're going to like, or for some reason offers them a spot, and you could offer your own fund lineup. But otherwise, I have an advisor in Jersey.
Can't offer your own
went up, and I'm trying to talk him out of it. I'm like, you do realize that if you only have $3-5 million in a PEP, it's more expensive than if they were on their own.
They are going to lose money. The advisor is going to lose money if they can only raise 5 or 10 or 15 million. It is not going to work out. So
I work on some MEPs in Florida, and 7 years it takes it to get to $100 million, and that was decent. But I have another client in New Jersey. They have a MEP, and they're still subsidizing the audit.
Yep.
They're an association, and they're still subsidizing the audit.
Yep.
And this is about 5 years in.
Well,
and they just know that it's a loss leader because they want to use the 401k plan to bring in members.
And plus, you have to remember they're not all the same, right? Some don't have 316. It depends. Got to create an environment where for the plan sponsor, and it has to be easy for the advisor as well. It's tough. Ours we have 316, all the stuff, all the bells and whistles, but it's tough. It's a lot of moving parts to organize. And it costs money. I mean, Ari, you're not working for me for free, so lawyers have to be paid, right? Everyone has to be paid. right? So,
Weren't they more common, Lyle, in the 80s, like multi-employer plans? Wasn't that like kind of a thing?
Multi-employer plans are union plans. Multiple
Yeah,
employer plans.
Taft-Hartley, right. But
That-
wasn't
that-
there like
that-
even
that's union plan.
non-union?
Yeah, multiple employer plans have always been there. It's always been part of the code. It was only up until 2012 when the Department of Labor issued an advisory opinion on the tag plan that said that if there's no commonality between adopting employers, then it's not a single employer for purposes of ERISA and purposes of 5500, and that was kind of a death knell for open MEPs. And we were waiting long for the DOL to come out with something. And if you remember last year, they came out with their kind of regulations on MEPs, and they still adhered to the commonality. So we needed to change the law through the Secure Act to finally allow, the elimination of commonality with these pooled employer plans. But I'm seeking opportunities to be a pooled plan provider. Been talking to a lot of people and a lot of providers. But I don't want to be a pooled plan provider of a $2 million PEP. It's just,
and there's also chamber plans out there as well. Chamber plans represent.
Chamber plans still would operate as closed MEP. You have commonality, and they'll still be a thing, and there's still an opportunity over there. Pooled plans are just a great way to market the micro plan market, or market to plan sponsors just don't want to be in the fiduciary game, as they say, and have be part of a pooled plan. But we'll see how it goes. I know that our buddy JD Carlson is a vehement opponent of it, and I know there are quite a few TPAs that don't like it, don't want to offer it. To me, it's like an ice cream flavor. People like cotton candy ice cream. I can't stand it, but for those who like cotton candy ice cream, I'll sell it to them. Of course, cotton candy ice cream doesn't cost a lot more than chocolate, but a poorly run PEP will cost a lot more than a single employer plan.
Yeah, I just think, just the last note, I think advisors have to be very careful who they partner up with. They have to be very careful. Not all MEPs and PEPs are created equal. Just like not all target date fund families are created equal. You got to be very, very careful.
Okay, so we've gone through 40 some odd minutes, and this is a good time to break. I just want to tell everybody we're going to do this again in 2 weeks, and the guest is going to be Chad Azara from PCS. Finally talk to a TPA and see how that business is going, where so much consolidation, and I can only imagine what's going on with their clients with the CARES Act. As an advisor, it's one thing, but dealing with clients, and I know a lot of providers are offering free amendments, and I think, was it John Hancock that's going to offer free administration for the first quarter next year if you sign up for them. So it should be interesting.
They did the same thing, and as we all know, nothing's free.
That's what I always said, but
there's nothing's for free.
Back in the day, prior to the regs coming out, I used to do an article, the myth of free administration. But it doesn't sound as well when we have fee disclosure. That kind of was, but it's still a gimmick, and we'll see what's going on with that in 2 weeks. And like I said, virtual conferences tomorrow. Sign up. You'll get an email tomorrow, and that's it. So thank you everybody for being here, and it's going to be available on demand and probably tonight on my YouTube channel, which we'll have on share you on LinkedIn and Twitter. Thank you so much.
Anyone have any questions? Anyone? Any other questions before we sign off?
I didn't see.
Thanks, Lyle.
No, thank you. Thanks, Greg. I see.
You're welcome.
Oh, Nikki there. Wow. Now, big wheel in the industry there.
Okay, so thanks everybody, and we'll do this again in a couple weeks. Thanks so much.
Okay, thanks, Ari. Bye, guys.
Call me with questions.